If you're looking to get rich and stay rich, here's the 7 assets you need to own for life. Yes, investing is a lot more than just stocks and bonds. If that's all you've been exposed to thus far, you're going to find out what other asset classes out there have enabled people to build tremendous amounts of wealth. Well, if you study millionaires and billionaires out there, what you're going to find is that true wealth building requires diversification across different asset classes. So we're going to be going through these 7 today: cash, equities, bonds, alternative investments, real estate, business, and private equity. And within each of those asset classes, each one of those has a unique strategy that changes over time. So think about every single one of those different diversified asset classes doing something differently for you, having a defined strategy, but also one that is adjusted as you get closer to your eventual goal, which for most people is retirement or just not having to worry about money to pay for their day-to-day life. So let's break each one of these into more detail now, starting with number 1, which is cash. Well, there's a saying out there that cash is king, and that statement is not more true than during a recession. And whether that means living off of your savings because you lost your job or buying the deal of a lifetime on a real estate deal, well, cash is going to be very necessary at those times and during the good times too. Effective cash management is probably one of the most important skills you have to manage to build wealth and keep wealth. And what that means is finding the right balance between holding cash and investing cash. Now, that being said, with the cash that you're holding in your reserves, well, all methods of holding cash are not created equally. For example, there is the high yield savings account, which a lot of people totally ruled out during the low interest rate environment, but interest rates are back, baby. And so in addition to that, so are higher yields on savings accounts. So that is becoming a much more important factor these days. There's also I-bonds, which is a way to outpace inflation backed by the US government. I just did a full video tutorial about them. So if you're interested, I'll put a card up in the corner. But perhaps the most important thing related to this asset class is your emergency fund. Before you invest, you must have an emergency fund, and most experts recommend that is enough to cover 4 to 6 months of all of your living expenses. Now, in addition to that I-bonds video, I recently did a video as well talking about the emergency fund and how to build that up as part of your overall personal finance portfolio. So I will put a card up in the corner for that video as well, talking about preparing yourself before investing and building up that emergency fund. So before you begin to learn how to manage any other asset out there, learn how to effectively manage your cash. It's your most important asset. Moving on, number 2 is equities. Now, equities is just a fancy word out there for stocks. And stocks provide investors the ability to own slices or shares of actual companies out there. Now, when you're younger, you want to have a greater allocation of your overall portfolio towards these stocks because that's when you can afford to take on more risk. However, even within the asset class of equities, it's important to have diversification within this asset class. So this means that you're allocating money to large companies as well as medium-sized ones and some smaller emerging growth companies. In addition, this means investing both internationally and in domestic markets. So if you lived in the United States, not only would you be investing in US stock markets, you would also be investing in global financial markets. Lastly, stock picking is very popular these days, and I certainly don't see anything wrong with that as long as you are managing risk appropriately, but you should have a blend of both individual stocks and investing in index funds and a portfolio-based approach. And this is usually the steps that people take. They start off with cash, they learn how to manage their cash, and then the next investment they make is usually equities. And this can be accomplished through a traditional taxable brokerage account or trading account, or it can be through a 401k or other retirement plan from your employer. So moving on, after equities, the next asset that people generally invest in is real estate. Now, depending on who you ask, some would say that a house is not inherently an investment. That is because your average single-family home out there is going to cost you a heck of a lot more than the equity you build up in it over time. Most people will call your single-family real estate a forced savings plan, not so much an investment. What I'm talking about is investing in real estate outside of your single family home. And so the most popular method of doing so, and the way I got into real estate too, is called house hacking. This is where you buy not just a single unit property, you buy a 2 to 4 unit property. You live in one of the units and you rent the others out in order to pay the majority or all of the mortgage. And then after you own that property for a few years, you can refinance and get some cash out to buy your single family house, and ideally use the cash flow from your rental property to supplement some of your mortgage payment. Now that strategy right there is probably going to take you 5 to 10 years to pull off. So it's important to understand that real estate is not a get-rich-quick scheme by any means. And if you treat it like that, you're probably going to get your ass burned in the housing market. However, with the right approach and the right attitude, real estate can build some serious wealth over time. And the key reason for that is leverage, which is something you have in real estate that isn't the case with most other investments out there. For example, $50,000 is 20% down on a $250,000 property. But if that property goes up 10% in value, you yourself capture that full appreciation. So 10% of $250K is 25 grand. So on your $50K investment, you just profited 25 grand. That's a 50% ROI because of leverage. That's so important to understand about real estate. So understand that concept. So that's it for real estate, but if you want to learn more, I did a full video about how to buy your first rental property, so I will put a card up in the corner for that. Now, real quick, guys, if you're looking to manage your cash and invest all in one place, be sure to check out M1 Finance, which is the app that I personally use to do the following things. With M1 Finance, I both invest my money as well as borrow against my investments, and this is more so something I do during a lower interest rate environment. But in addition to that, M1 Finance lets you invest, borrow, save, and spend all in one place, so it can allow you to accomplish many of these different assets that you're looking to have exposure to over time, all within one financial super app. So if you want to check it out, guys, the link is down in the description below for M1 Finance. I am affiliated with them, so if you sign up with my link, I may earn a commission in the process. I also have a completely free M1 Finance training that walks you through personal finance automation. So if you want to check that out, that is also going to be linked up down in the description below. And the sign up link for M1 Finance is going to be ryanoscribner.com/M1-finance. Okay, guys, so the fourth asset you must own for life to become rich is bonds. Now, early on in life, it's not as important, but as you get older, bonds are extremely important because this allows you to de-risk your portfolio. So we've already talked about equities or stocks, which is having actual ownership in a company. Bonds are actually debt instruments where you're actually just a debtor that is owed money by the person you are basically loaning that money to. So with bonds, you don't actually own anything. You just have an entity that owes you money. And what you do with bonds is early on in life, in your 20s, you might have none of your net worth in bonds, but as you get older, you want to put more and more in your portfolio into bonds, typically every 5 years. Now, a good rule of thumb to use is you can take 120, subtract your current age, and that will give you the percentage of your money that you should have allocated to equities. The other amount should be in bonds. Now, guys, there's more to it than that. That's just a simple rule of thumb. But for example, a 25-year-old would take 120 minus 25, meaning 95% should be in equities with 5% in bonds. But a 50-year-old should take 120 minus 50, which would be 70, meaning 70% in equities or stocks, 30% in bonds. So as you get older, more and more of your money is allocated into bonds, meaning less growth potential, but you're also de-risking, meaning if the market collapses, you have less downside risk and your portfolio will be propped up better. Now there's 4 different types of bonds out there, but most people are familiar with the most common 3. The first is corporate bonds. These are issued by companies looking to raise capital. Next, there's municipal bonds, which are issued by states and local governments to fund big projects like roadways or water lines. And then you have government or U.S. Treasury bonds, which come straight from the U.S. government. The other category is agency bonds issued by government affiliate organizations such as Fannie Mae, but most people are familiar with the top 3 as those are more common. And instead of individual bond purchasing, what most people are going to do is invest in a bond index fund, which is a basket or portfolio of many different bond funds. And within that, you're usually going to have a mixture of corporate and treasury bonds, and in some cases, municipal bonds as well. Alrighty, so number 5 on the list is cryptocurrency. Now, is it necessary to be in your portfolio to become rich? Only time will tell. But at this point in time, while crypto is still deemed a speculation by many, a lot of people are saying it should have an allocation within your portfolio. Now that being said, based on how speculative this asset class is, by no means should crypto be a major portion of your portfolio. Let's look at Mark Cuban, and he's somebody who had a major investment in a crypto exchange that went completely under, so you may not even want to listen to his advice on crypto because he was too far into it and got burned. But he said you could allocate up to 10% of your portfolio in high-risk assets such as crypto. That's probably a bit aggressive for most people, but I would leave you with the rule of thumb of maybe putting 1 to 5% of your total portfolio or total net worth into cryptocurrencies to see what happens over the long run. And no, I'm not talking about meme coins or anything like that. I'm talking about solid, durable crypto assets. You're going to want to focus on projects or ones that you understand and ones that have been around the longest. So for example, Bitcoin is like the digital gold. You'd want to have that one on your list. Next, you'd also want to have Ethereum. And then I also want to point you towards GBTC, which is an interesting way to purchase cryptocurrency, Bitcoin in particular, in a traditional brokerage account through the Grayscale Bitcoin Investment Trust. Now notice that Dogecoin is not on that list. Neither are many of these altcoins. Look, it's up to you. If you want to put a percentage of your percentage into that individual altcoin, by all means, you can do that, but make sure you understand what the heck you're investing in. Okay, guys, so moving on. Asset number 6 is the asset class of owning a business. So owning or operating or selling a business is a major wealth building strategy. So let me just kind of explain the differences there. Owning a business usually implies that you are the actual owner with equity, but it doesn't necessarily mean you're involved with the operations. So for example, I own a slice of many different blogs out there that I created. I sold off some equity for different reasons, some for raising cash, some for strategic partnerships, but I own a more passive stake in these businesses that are sort of self-operating. So those provide a passive source of cash flow for me. Operating a business means that you're actually actively operating it yourself. That's like my YouTube channel, and that is another source of income for me. And then selling a business is a major wealth building strategy too. I have sold, I think 4 different types of structures now in terms of selling a royalty on my YouTube channel. I've sold percentages of most of the blogs I've started just because I like to deploy the strategy of hedging as well as diversification. So a business is not necessary, but it's always something to consider. And I want to point you towards this lesson here, the cash flow quadrant. And this comes out of Rich Dad, Poor Dad by Robert Kiyosaki. And this for me is always the best visual representation for me, for people to understand the difference between being an employee, being a business owner, being self-employed, and then being an investor. We've mostly talked about the investor category so far. Now we'll talk about the others, but we'll go through all of them. So odds are you're currently in the E category or the S category in addition to the I. Most people are not in the B, and that's where you want to end up. So as an employee, you have a job, and that's usually an acronym that stands for just over broke, because that's the situation it usually keeps you in. And the amount of time that you actively work determines your income, and time is directly proportional to money. So that's where most people start, and then what they usually do is direct a little bit of that active income to the I category as an investor, where you own investments. This is where your income does not depend on active work and your money works for you. This is great if you have a lot of money or a lot of time, but if you don't have that, then it's not such a great option. I mean, it's your only option in some cases, but the S and the B category are other options that you really want to consider. Now, most people, when they start a business, they go from the E to the S, which means you go from an employee to self-employed. So instead of having a job, you own the job. So let me give you an example of that, and this is the most common way it goes down. Let's say you work for someone as a landscaper for $25 an hour. One day you find out, hey, my boss is making a heck of a lot more than $25 per hour. I'm just going to book directly with these clients or somehow circumvent him and get myself out of the middle. Then instead of basically landscaping for someone else, you own the landscaping service that you're performing. The problem, though, is that you are still actively performing that role, meaning you can only scale it to the maximum hourly rate or per job rate that you can earn off of your own landscaping services. So time is still equivalent to money, but you're going to be able to make a little bit more money because you're not working for somebody else and making somebody else rich. You're basically selling your own service. The business owner is really what you want to focus on to build a lot of wealth, and this is where you own a system or operation. That's exactly the case with my blogs because they're self-operating machines where I just get a check every single quarter. In this scenario, your income does not depend on active work. People work with you, and as a result, this generates money, and it doesn't really have a relationship to your individual time component. So that's how the business asset class works. Not necessary, but always something to consider, and it's a tremendous wealth building strategy. This is mostly what allowed me to become a millionaire, in addition to my real estate investments and the private equity, which we'll talk about later on. So through my business, I went from being employed to self-employed by doing YouTube, but then I started these different blogs, which became self-operating business, which truly, is what allowed me to become a business owner and not just, a self-employed YouTuber. And as a result, I was able to earn a lot more per year than you would think you could as somebody in their early 20s. And so I was able to direct a lot of that money to the investment category, far more than you would working at a job. And one place where I directed a ton of that money was private equity. So if you become accredited, which is based on your net worth or how much money you make annually or licenses that you hold, you have access to more investments, and this gives you access to alternatives or, in particular, startups or private equity. Now, the reason why you have to be accredited per the SEC is because there is really high risk associated with these types of investments. As of 2021, according to Investopedia, 20% of startups failed in the first 5 years, with 50% failing within the first 5 years and 65% failing within the first 10 years. So with that high of a level of just a failure rate where you would literally go zero on your investment, they make sure you have to be accredited to basically, have it be somebody who could financially take on that amount of risk without having it completely destroy them financially. So for me personally, because my income is so high and my net worth is in excess of $1 million, the SEC believes I can take on stupid risk, and so I do that, basically. I just did a video recently on my 6 startup investments, and if you want to check that out, I'm going to put a card for that in the corner, but we'll talk a little bit about it here just so you're more familiar with the asset class of private equity. So the stock market is the public equity market. You buy shares on a major exchange, usually the New York Stock Exchange or the NASDAQ. Private equity is the backdoor, closed door door deals where you're investing in a private company, typically at a much more early stage than you would if you're buying shares on the stock market. And this is what it normally looks like. You have the seed funding at the very beginning, which leads into a Series A, followed by Series B, Series C. It can keep going from then on with the goal of an eventual IPO. So you typically have somebody who comes together with an idea. They then go to their friends and family and they have a seed funding round at the smallest valuation. And they say, hey, here's my idea. Do you want to pitch in and contribute? From there, they build up proof of concept, which is what leads you into the Series A, where you should have a much higher valuation, be able to raise more money to take that proof of concept and scale it up and see if you run into any growing pains and see what happens. From there, you go Series B, Series C, and then what these days people are normally looking for is for that company to aim towards profitability, or at the very least having really strong revenue growth, which could justify high operating costs. And then there is the eventual IPO, initial public offering, where your average mainstream retail investor can buy shares. This is when you yourself, the private equity investor, are having your exit. Now, you might have a lockup period as an insider, which means you can't sell shares for 30, 60, 90, X number of days, but just understand that you get this idea in mind that the private equity exit is when the retail enters that position. So it's kind of this weird scenario where the early investors are unloading to de-risk, while the retail herd is like, I want your risk right now. So the IPO in general is sort of this weird investment, and something we'll talk more about in a later video for sure. But yeah, it's an interesting thing to just understand how private equity works and how that ties in with the stock market. So yes, being early on the right investment can make you filthy rich. I personally have 6 private equity investments. My plan is to build that up to 10 in the next few years, and I hope to have one big winner that makes me like $10 million or maybe $100 million. That would be awesome too. Alrighty guys, so that's going to wrap up this video here on the 7 assets to own for life. I hope you enjoyed it. If you did, please drop a like, subscribe, and hit that bell for future notifications. There's a bunch of great videos up in the corner to check out, as well as links down in the description below. Also, if you're curious about how I was able to go from a redneck living in upstate New York with a $10,000 net worth to becoming a millionaire by the age of 26, that's the premise of my book coming out in January called From Side Hustle to Main Hustle to Millionaire. That book is officially available for pre-order. Details are on my shirt. It's sidehustlebook.info for more information. And I talk a lot about my different investments in private equity and in different businesses, selling off portions of my different blogs, and even selling a royalty in my channel to de-risk and diversify. So it really explains how I was able to build this wealth and keep that wealth, and I'll continue to document that process here for you on YouTube. Thank you guys so much for tuning in, and as always, I hope to see you in the next video.